Welcome to the Wall Street Lab podcast, where we interview top financial professionals and deconstruct their practices to give you an insider look into the world of finance. Here are your hosts, Lucas Muzialski and Leo Severino.
Hello and welcome to episode number 19 of the Wall Street Lab podcast. Today we're going to be talking about asset management as well as careers in the financial space. And in order to do that, we have Jane Coffey on the show. Leo, can you tell us a bit more about Jane's background?
So Jane Coffey is an executive coach for investment professionals, but she actually wears a lot of different hats, as you will hear during the interview. Among other things, she's heavily involved with the Cfa Institute in the UK. She is also involved in an interesting project, and you'll hear more about that in the interview, with behavioural finance. But before she became an executive coach, she spent most of her career in the asset management industry, having been the head of equities and executive director at Royal London Asset Management before she became a coach. So for anyone who's interested in career advice in the asset management industry, I think this is going to be an interesting one for you.
Yeah, this is a really awesome episode for everybody that is into investing and looking for career advice in the finance space. Jane talks a lot about equity investing, how behavioral finances biases affect even the most professional asset managers and how they try to get around them by using specialized software. Also, for all you young people trying to start out in finance, she's giving very insightful tips in how to effectively do networking, how to get educated in the best way, and which master or MBA or CFA is the right fit for what you want to achieve. So I really hope you enjoy this episode.
If you enjoy this episode, please leave us a 5-star review on iTunes. It really helps us to grow this show and reach audiences similar to yourself who are interested in listening to this type of content. And now, without further ado, please enjoy our interview with Jane Coffey.
Hello, Jane. Welcome to the Wall Street Lab. And first of all, thank you for accepting to be part of the show. And just so that people know, we were first introduced by each other by Ian Morgan, who was on the show a few months ago. And his episode became the most downloaded interview we've had so far. So, Ian, if you're listening, thank you very much. You both have a very similar background. You know, Ian was an MD at an investment bank. And you used to be an equity fund manager, and you both decided to change careers and become many different things, including becoming a career coach. And what I find really fascinating about you is that you're involved in so many different fronts, from being a career coach, an executive coach, your involvement with the Cfa Institute, your work with behavioral finance and data analysis, and we will touch on all that later. But why don't we just start by telling us your previous career as an equity fund manager, maybe just a brief introduction.
Yeah, well, thank you very much for inviting me along, actually. It sounds like I've got a lot to live up to meet Ian Morgan's number of listeners, so I'll try and keep it interesting. I started in equity fund management in 1987, which most people probably won't remember was also a year of a massive equity crash, although that seems to have disappeared out of most people's memories given the financial crisis that we had 10 years ago.
Yeah.
But I thought it could have been one of the shortest equity careers. However, I managed to struggle on for 25 years. And, it's a really interesting career. I mean, I have loved being a fund manager. It's changed a lot over the times that I was working in fund management. But for people who continually like learning, it's a career that's hard to beat. I started as a European equity fund manager, and the reason primarily that I got into concentrating on European equities was that I studied French and German at university alongside economics.
Okay.
So it was a very obvious sort of geographic region for me to.
So we can do the interview in German?
Ja, natürlich.
Wow, okay.
I was managing European equity teams and was increasingly interested in how you get your team to perform and how you get people to work together. Mm-hmm. I moved from Provident Mutual to Aviva Investors and then on to Sun Life of Canada, always running European teams, and then finally moved to Royal London Asset Management, where I headed the global equity team for Royal London. So increasingly, it was the managing the people as well as managing the money that was intriguing me. And there, my whole interest in behavioural finance and the psychology behind investment decision-making began to grow. And so 4 years ago, I decided that actually the formality of being in a large investment house and the fact that you needed to be in the office every day, the news was new. What you were doing was very similar. So I felt that I needed a little bit more flexibility in my life. And when I listened to Ian's podcast, that seemed to be very much one of the reasons behind his move as well. I started studying coaching to see both that was helping me in my old career, but started to open my mind to the fact that I would be able to actually go out and work on my own and go in and coach other fund managers on a more flexible basis with my time and constantly just look at the part of my role that I was currently really enjoying rather than all the other areas around my life. So I think this is something that is really ongoing in careers these days. I think you need to be able to continue to evolve in order to stay interested and on top of your game and to continue learning. And we will all be changing our jobs several times, in fact, changing our careers several times during our working life, I believe, in the future. So this was where I started thinking, well, what could I do? And as you mentioned, it turned out that there's lots of different ways that this can be used, fingers in many pies, and it's really reinvigorated my working life, in fact. So I do some career coaching. That is helping people newly into the industry, but also, and people wanting to get into the industry, but also people who don't want to move but want to do better in what they're actually doing. And so that's kind of the career/executive coaching. I also look at, as you say, I work with Accenture software, and this is a behavioural finance software that is sold very much as a service. It comes with insight sessions from people like myself. There's several of us that are coaches, and we work with the data to look at the behavioural patterns of your own personal investing background. So we can run 10 years, 15 years worth of your investment decisions from your trade data through the software and look at the patterns of behaviour that you actually portray. So when do you buy stocks? What happens as far as your exit timing? You know, do you tend to exit stocks late? Do you tend to sell winners too early? Lots of different patterns that generally reflect behavioural biases, and it's quite difficult to see from standard performance data. And this allows us to sort of start looking at how you're making your investment decisions and what prompts might help you make better decisions. All of it is really looking at how can I personally use my experience to help and prompt other people to be the best that they can be. And that's what's really the motivation now for me in my career, and that's what made me switch.
Okay, yeah, that makes a lot of sense, and I have about 120 follow-up questions. I mean, you touched on a point. You said at the very beginning that the fund management industry has evolved and changed a lot since you started, what is it now, 30 years ago, 1987.
Yep. Yeah, 1987, 30 years.
So how has it changed? Can you maybe elaborate on that?
I think it's changed in a lot of ways. The last 10 years the biggest changes have come through both regulation because of the financial crisis, and secondly, just the ability to use data in a much more sophisticated form. When I first arrived in the city in 1987, we had a team computer sitting in the corner. You had to kind of take it in turns to use the computer to do things. And now, obviously, we all have several computers in what we do. Or the pocket phone has more computing power than I think the entire trading floor of the first house that I worked at. I think the biggest thing that has changed is how you can manipulate masses of data. We become much more dependent, really, on what's coming out of the computer, but also empowered by what's coming out of this data.
But that data, do you think that we, that we human beings are better able to take advantage of that massive amount of data than some algo trading hedge fund manager that uses sophisticated trading models to be able to take advantage of pricing disruptions in different markets?
I think there are so many different ways that you can make money through investing, and it depends on which inefficiencies in the market you're trying to exploit. So, you do different things if you are a long-term investor than if you're a short-term investor. I would never try and trade short-term. I would never try and day trade, and certainly trading currencies and things like that. I'm sure Morgan Stanley, Goldman Sachs, any of these big houses are going to have much better algorithms to follow pricing trends than I could ever have. What you're trying to do in the world that I've worked in, which is long-term investing, was to really understand what the trends were in the underlying industries, the underlying businesses, what was happening to profitability, what was happening to growth in companies, and how that was then reflected in the share price. So when I'm talking about the amount of data that we're using now and the algorithms you can use, it's less about price data in the market and much more about how you can use data to mine answers to questions that you would never have been able to do before. Things like the retail sales data or trends coming through in that you can get from all kinds of different sources that were not available to you before.
Okay, yeah, that makes sense. Now, you are also involved with the Cfa Institute in the UK, and it's been now 9 years after our last financial crisis, and I guess the industry still has, in my opinion, a bad reputation among the general public. If you look at, private equity or hedge fund managers or investment bankers' compensation, they're now probably as high as they've ever been, generally speaking. So it's sort of understandable that if you're not part of the industry, you may get upset about many different things, and compensation might be one of them. So can you maybe talk about what are some of the things you do with the Cfa Institute that may or can help change that?
What I'm doing in the project on the value of the investment profession is looking at how we can show what value we are bringing to the table as a profession, what that real value is and how we can increase the real value that we're delivering, but also the perceived value, which at the moment, as you suggested, tends to be less than what we think the real value is. So there's a lot to go on in that value chain in getting people to recognize that we're not a whole load of people that are just out there taking a massive salary and adding no value whatsoever. What I'm doing in this project is looking along with around 45 senior investment professionals in London at a whole load of questions around how can we improve the way that we make decisions, that as far as our effect on capital allocation in the economy. So if we are very short term in what we are doing, then it's likely that we are going to be talking to companies and we're asking them, you've got to deliver this quarter's earnings and then next quarter's earnings, and you can't disappoint, you've always got to be making more profit. And that can stop investment in capital in the economy. So can we look at how can we maximize the long-term returns from our capital in the economy? How can we encourage companies to invest on a sustainable basis? So again, this is more use of environmental, social, governance best practices. How can we get fund managers to integrate these aspects into their investment process in order to deliver sustainable increases in value rather than short-term boosts in profits that then will fall? So sometimes when you're a fund manager and you're looking at performance of your fund every quarter, you forget that these decisions that you're making are affecting big swathes of the economy because whilst we're not allocating our money directly into investing in new machinery or expanding companies, we are giving them the signal through the way that we price capital as to what they should be doing. We're also giving them very strong signals in the way that we talk to them when we vote at AGMs, when we engage with them directly on strategy. If we can keep doing this in a way that helps all stakeholders and creates sustainable value, that's something that will be improving the value of the investment profession.
Absolutely, yeah. I work in private equity in my day job, and I look at, you see the topic of ESG coming up more often than ever before, and, I'm sure that there are some academic papers that try to understand whether or not managers that use an ESG strategy are able to actually perform better than those that don't. But I haven't read those papers yet. But I think the problem or the issue here might be that unless we're able to prove that you can do good to the society, and also do well to your investors, meaning bringing better returns than your benchmark or the average investor. So if that doesn't happen, then it will be a difficult sell. It's sort of the same thing with the carbon credits and the environment. Unless it touches on people's pockets, I think it will be a difficult sell.
I think that's right, and I think it's why it has been a difficult sell in the past, because a lot of what happened with ethical investing, for instance, or the first kind of green funds, were very much about excluding parts of the market. So you weren't allowed to invest in, for instance, arms or tobacco or alcohol. And, these are areas that have had great long-term returns, actually, over time. What I think is happening now is that we are seeing the way that ESG is moving. It's looking very much at what are the long-term risks and threats to companies which are not normally taken into account when you are looking at your next 1, 2, 3 year numbers. So it's kind of high impact risks on a low probability basis. How do you bring that into your calculations? So the sorts of things that you're talking about, like the carbon and really trying to get rid of carbon in your portfolio, which is interpreted primarily as reducing oil in your portfolio. Well, if you look at all the big trends that are going on now, we're now talking about electric cars coming in on a sort of large scale within, say, the next 10 years. And oil, we probably have reached peak demand in oil. It starts becoming a measurable economic effect. But what we don't know is when this is going to happen. What we do know is it's probably going to happen in a much bigger scale than we thought. But it's hard to factor in when in our models. And so I think this is the sort of thing that can have a massive impact downside, you won't know when it's going to happen. I mean, even most recently, tobacco, the tobacco stocks, which had been continually growing in profits and particularly in return on capital, despite the fact that the number of cigarettes they were selling was going down globally. Mm-hmm. We've just had a really big fall now in the sense that the US has stepped up what they're talking about as far as nicotine is concerned, and they want to force cigarettes to have such low nicotine that they will not be addictive. Okay. This could make a complete game changer on how tobacco is going to survive. And that has always been a risk, because we've known tobacco has been bad for a long time. So it's trying to put in lots of things that can come along and hit you at an uncertain time in the future. It's not just doing it for it'll be nice for society. It's actually going to make a big difference economically too. Okay. There are quite a lot of studies already that show better companies on ESG criteria have been outperforming companies with bad ESG criteria, but that is likely to improve over time. So it's not going to be costly to be good. It's actually going to be good to be good.
Yeah, that's very fascinating. A very fascinating topic. Let's move to the actual main reason why we're talking today, and that is your career now as an executive and career coach. Yeah. One of your careers. Let's maybe break this down into two parts. The first part would be if you're meeting a person that is just starting out in finance. Can you maybe tell us what are the first things that you do when you meet them?
I think the most important thing to start with is to really try and help them decide which area of finance and investments in particular they want to be involved in. Because quite often people are at university, they think it's an area that they want to be in, but it's quite unclear which area of both assets, company cultures, what actually is going to be something that is good for them. They just have this nebulous idea, I want to be in the city. That's a really hard target to have, because what I found was, therefore, a lot of people were coming to the graduate recruitment round saying, I really want to be in the city. I'm applying for everything. I'm applying for investment banks. I'm applying for trading. I'm applying for derivatives. I'm applying for fixed income. I'm applying to the big investment managers. And that's quite difficult to then research before you go for your interviews because you are never going to be an expert in all those things. So the first thing to do is to really try and get some focus on your search. And the more research you can do in what does success look like in these different roles, what are the roles, what would you be doing on a day-to-day basis, what kind of culture suits you in a company, are you going to be more successful in a large company, a small company, a cutthroat competitive environment or more of a team working environment. You need to ask yourself all these questions and then find out where those jobs actually would reside and kind of make a short list. So it's all about funneling down what the opportunities are into a smaller set of opportunities that would really suit your motivations, your interests, your personality type, and your skill set. Once you've got to that kind of area of focus and you've thought about what's your skill set, what's your personality, what does your experience that's made you who you are today, what has that given you as far as drives and interests, you have both sides of the story. It's then really about fitting them together. So if you've done all this research, when you come to write your CV, when you come to write your LinkedIn profile, when you want to target who are you going to actually apply to and make really good applications to, which people should you be contacting, that all becomes a much more obvious output because you've done the research in the first place. So my first thing is focus.
That's absolutely good advice. Now, it's not long ago that I was doing my master's in finance, and I remember there is a lot of peer pressure in business schools.
Yeah.
And I remember, I think we had a group of 120 people in my intake, and if you're not interested in investment banking, you're not part of you're not one of the cool kids. So, and I wasn't. I mean, there's nothing wrong with investment banking. I just wasn't interested. I was more interested in asset management. But I think not everyone would have dealt with this pressure the same way. I'm assuming that there are a lot of people who end up in investment banking or in a position because all of their friends want to be in that position. So how do you deal with that? How do you prevent yourself from getting in a situation like that?
I think, again, it's about asking yourself what kind of job would suit your interests and your personality type. I think investment banking can be a great career for certain types of people, but it's not for everyone, and nor is fund management actually for everyone either. Yeah. But they are quite different skill sets that are needed. Quite often it's the same education that people have been through because, as you say, masters in finance, MBAs, they all go into investment banking. They also all go into fund management.
Yep.
Increasingly now, actually, fund management is the area of choice, partly because salaries have been going up in fund management for quite a long time now and going down in investment banking. But not only that, it's also because people have realized that the work-life balance is a lot better in asset management than in a lot of investment banking roles.
Mm-hmm. Yeah. Well, that makes sense.
So I would say don't follow the peers. Try and understand yourself and try and understand what your motivations are and what would make you happy, and then look at where you can find that.
Okay. Now, for the people who are just starting out, there is always a problem, it's sort of a chicken and an egg problem. You can't get a job because you don't have work experience, but companies don't hire if you don't have work experience.
Yeah.
So how do you make yourself interesting to recruiters if you don't have any work experience at all in finance?
Yeah. Well, I think ideally you try and get work experience all the way through your studies as much as you can. Any opportunity that you can get to get internships and that kind of thing. It's never too early to start trying to get some of that experience, because it's also something that really helps you on looking at what kind of roles would be good for you, what are those roles really like, what culture would work for you. So those questions that we were talking about in order to get your focus, the more you can actually experience some of what it's like, it may be that your work experience tells you, well, whatever happens, I'm never going to do that again. You may find places that you really dislike. So ideally, try and do as much of that as you can. And it doesn't have to be totally formal internships. If you can get in touch with people, try and get in touch with alumni from your college, people that even people that you might see in investment journals or reading that you do. If you can reach out to them and try and engage them some way to meet with you, to talk to you, to respond to you, that may give you an opportunity to actually get some of this work experience and to get you to stand out from the crowd. As an investor, I think, the other things that you can do is certainly join the investment club at university, run a paper portfolio of your own, read as much as you can on the internet about what's going on in the industry, write a paper around a particular topic, put it on a blog on the internet, put it on LinkedIn, depending on how much time you've got whilst you're doing all the studying. Hopefully it's going to be tied in with your studies. If you can actually reach out to practitioners to help you with your research and doing a project or something, I mean, that is absolutely ideal.
Yeah.
Yeah, because you then have something that you're asking them about. You're asking them about their professional ideas, and people like being asked about things, so long as it's by somebody asking intelligent questions for a good reason, you know. They don't like being asked about things that you could have read on the internet and, you know, you haven't done any research before you start.
Right, absolutely, yeah. And this is actually one of the things that I realized with my colleague Luke, who also does the podcast with me, is that, you know, people are so kind with their time if they realize that you actually put in the work to understand what they do, to understand what their focuses are. So I think this is a very important piece of advice. Sometimes all you have to do is ask.
I think so, and I've been amazed, helped me over time, but increasingly I've seen the results from my career coaching clients who've done amazingly well at getting to speak to all kinds of people, and, you know, it's worked really well for them. Using the non-advertised roles, everybody talks about 70% of the industry is employed through jobs that are never advertised. I don't know whether that statistic is right, but what I do know is that if you send in a CV to an advertised role that has 500 CVs, as you just said before, it's really difficult to stand out. If, however, you've actually met some of the people that are working there and you've talked to them and you've impressed them as being someone who is really keen, has a great attitude, has done some research, is really focused on where they want to go, you're much more likely to get through to that first interview stage, because people are going to be prepared to say, yeah, I hear Joe's applied for this role. I met him. He was great.
Yeah, and now you're touching on a topic that, you know, a lot of people struggle with, me included, and that is networking.
Yeah.
So, is there a right way to network? Because, I mean, if you go to let's say a Cfa Institute event, you watch a presentation, and then you have 30 minutes trying to start a conversation with some other people. So, what's the best way to go about that?
Okay. Well, I think networking covers an absolute myriad of things. As you say, there's networking events, which, you know, do have a place in the part of networking. There's LinkedIn, which again has a place in networking. Neither of them are the whole thing though, but both of them can be really good tools. Mm-hmm. I think what you need to do before you start with this is, again, think, what do I want to achieve? You need to have some target and some focus on your networking. So the networking that I was talking about as far as getting informational interviews, getting some ways of meeting people who might be able to help you either with information or potentially with jobs or knowledge of jobs 2 degrees of separation away from them. Mm-hmm. That is all about you going out and reaching targeted people. So look at, once you've decided what kind of role do I want, what kind of company culture do I want, let's say I've decided I want to do emerging market equities. Mm-hmm. I see that as a really interesting area. It's an area of growth. Which are the firms that are most revered for emerging market equities? Let's look at who are the best performing managers in this area. Who are the guys who are winning the money? Who are the guys that are doing something a bit different in that? And try and work out who would be good to contact. Then it's about getting in touch with them. And once you've found some names, found some companies, started getting in touch with them, you start building your network in the right place. Just going into a room full of other people looking for jobs and calling that networking, you might meet some friends, you might have a few free glasses of wine. You will probably even learn something from the CFA speech beforehand, you know, that's good too. But the likelihood of you actually doing some networking that gets you a job is probably quite small. I think networking is, what is your purpose to your networking? And then work on a strategy that gets you closer to your goal. Don't just try and collect 500 friends on LinkedIn, 500 names on LinkedIn, who you never get in touch with, or a whole load of other friends who you've met going to Cfa events and they're all looking for a job. I think neither of those strategies are particularly useful. However, a really targeted networking approach to getting a job is very effective.
But how about for those who are not looking for a job? How about, say, you've been around for 5 years, working in an asset management firm, and you don't want to network for a particular reason. You're not looking to get anything out of relationships that you have.
Yeah.
Is the approach different there?
I think the approach is different because you're looking for different things. What I would say is worth investing in your network when, in that particular instance, is what you're wanting to do is to establish yourself amongst your peers and to also find out what are the trends, what are things going on, what's at the cutting edge, what are other people thinking about in your industry that are very specifically in your area of interest. Mm-hmm. Send them interesting article that you've read on a particular topic of mutual interest. All these things are ways of just making sure that you're seen as somebody who is helpful. You're seen as somebody who's really interested in developing best practice within the industry.
Absolutely. Whenever you meet a client that has been around the block for a while, mm-hmm. and they're not at the level where they want to be yet, but they want to get there. Let's say it's an equity research analyst who wants to become a portfolio manager.
Yes.
What would be some of the things that you would work on with that type of client?
I think there it is about what are they doing to move them forward towards their goal. People do get stuck at times. They've been very successful up to a point and then have not been able to progress further. And sometimes it's because they're in the wrong place, but quite often it's because they're not doing things to continue to raise the bar up to the next level. So if you try and put yourself in, what would I be doing if I were a portfolio manager, for instance, how can I acquire some of those skills that perhaps people are saying, well, you don't have that. You know, you're very focused on this industry. If you're a sector analyst, for instance, and you want to become more of a generalist portfolio manager, maybe you need to do a sidestep to a different industry first. Or maybe you just need to go out and raise your profile externally as a thought leader in that particular area so that they can see you as somebody that's respected in the industry as a whole.
And how would you do that? Would you write books or articles, or how would you go about doing that?
Just lots of places that want information, that want articles. You know, you can do LinkedIn, you can do, in particular, the financial press, CNBC and Bloomberg TV. They're always looking for people to talk about what's going on in the market. So putting yourself forward, being prepared to volunteer to do things like that or to speak at a conference, those kind of things, it's about kind of, you know, just getting up there and saying, yes, I'd like to do that.
Yeah, that makes sense. Now, one question that people might have is you mentioned that sometimes you're not able to reach the next step in your career because you might be at the wrong place. Mm-hmm. But on the other hand, you don't want to leave too early because you never know if things are going to change. So how do you actually know that the next best step is either to stay a bit longer and see what happens or to move on to a different company or a different area?
Well, I think these are the sorts of conversations that I would have with the career coaching clients that I do have. It's like, let's look at the options. Let's look at where you are now. Generally, it's easier to move where you are now than to move somewhere else. If you're doing well, you know, and it's about making sure people notice that you're doing well and that you're ready for the next stage. So hence what we were just talking about. But if it becomes apparent that those options are not really opening up, or you've already actually asked and you've pretty much been told that it's not there for you, then I think you have to start looking at where the other options are. Again, the networking helps with this, because if you have a good external network, you're likely to also be able to have those conversations about what's going on in other places without actually saying, I want a job. If you have a good network of friends, you can see where is expanding, where is not expanding.
Now, you used to be a fund manager yourself for many years, and now you help make fund managers better at what they do through behavioral finance and through the software. In your experience, what is it that differentiates a good fund manager from a great fund manager?
I think it is the ability to be confident enough to hold a contrarian view through the noise of the markets, but to be humble enough to accept when you're wrong. So it's that funny combination between high conviction ideas versus constantly double checking whether that idea is actually right, or whether you're just in denial and in fact it was you that was wrong, not the market. So I think that's the difference between a good fund manager and a really great fund manager. The great fund manager still feels humble enough to know what they don't know.
Yeah, absolutely. We've had lengthy conversations about behavioral biases and behavioral finance, including with Dan Kemp, who's a CIO for the EMEA region at Morningstar Investment Management. And I remember him saying that one of the ways that you can help yourself as a fund manager make better decisions is to run your idea through a group of people, let's say an investment committee. But then you run the risk of groupthink. Because you have people agreeing with you all the time, you actually might make worse decisions than if you were on your own. How do you strike that balance between being independent enough, as you mentioned, and not fall into the groupthink trap?
Yeah, very good question. If you can't convince other people of your idea at all, then it's unlikely that your idea is a terribly strong one. So you need to be able to explain what's the investment thesis behind why you think the market's wrong, why you think this company is something that you want to invest in, where exactly the upside is to this company's valuation, and what the key tenets of your argument are. It's right. If you can get a committee on side with your idea, it probably shows that there's at least a chance that this is a good idea. What I think is good in a committee environment is that you should always have people trying to see the other side. You need to have somebody whose role is to see the other side of the argument, to be the contrarian, to try and pick the problems in that investment case. It is difficult to run a portfolio on a committee basis. You need to have somebody who has the end say, whether that's the portfolio manager and they're taking individual ideas from a team of analysts, or whether it's the chair of the committee who effectively has the final say. You need to know who is accountable. But having a designated contrarian, or just somebody who always thinks differently to the team.
Okay, absolutely. I've thought a lot about behavioral finance, and I think most people get it now. Maybe if you talk to most investment managers in the 90s and you said you should start looking at behavioral finance, they would probably laugh at you and just move on. Kahneman, Dvorsky, Thaler, there are so many people that have written about it that we're convinced. Okay, we know we understand the importance of it, but it's still so hard to go against those cognitive biases that we have, because it's part of our nature. It's a part of human nature to commit those biases. So I find it fascinating to learn about it and understand it, but on the other hand, I myself find it difficult to put it into practice.
No, and I think that is definitely true for the vast majority of people. And one of the things that has been done a lot in behavioural finances, that investment teams go to various presentations, they'll read some books, they'll think, oh, really interesting, fascinating. They can then see it in other people, but never in themselves. So I'm not like that. And of course we all are. So one of the things that I do with the help of the Accenture software service is that we can actually point things out to people about how they themselves have behaved, and it's all their own past history. So the evidence is there as to which biases you are most affected by. Because different people have different extremes. Some people are really excellent at running winners. Other people, either through their own cognitive bias or because of the way that their investment process works with target prices, they may set a target price and they sell when it gets to the target price. Now, that sounds like a really good investment process, but it could be that we can show they miss a lot of upside for most of their stocks, and it's because they haven't changed their target price. How often do you review your target price? If you know that you're missing 20% upside on 70% of your stocks, you need to look at how you're actually using your process. You've got some data, you've got some information, you've got some knowledge about what the cognitive biases are, but how can you actually change something, and how is that changing your behavior that can be part of your process so it reminds you what you're going to have to do?
What are your thoughts on the value of programs such as the MBA, master's programs, and the CFA, for example?
Education generally has to be a good thing. Education, however, is very expensive, both in time and now in absolute cost. And so you do need to look at what are you actually getting out of the different programs and how useful they will be in your future career. If you have decided very much that you want to be in portfolio management, asset management, then I think that the Cfa exams are the ones to focus on. Because I think they're very focused on that area and they're renowned as being pretty tough exams to get through. I think there's a lot to be said for the master's programs in finance that give you a very broad spread of knowledge about a much wider area of investments and finance, and therefore could be more useful in a lot of other different roles. And similarly with the MBAs, it's a much broader qualification and gives you a much wider range of things that you could do. So if you haven't decided exactly what you want to do, then the MBA will probably help you decide, because the areas that you're particularly interested in within the program will be areas that you may want to pursue. But I still think that the CFA is, for asset management, is the number one qualification. And even if you've got an MBA, you'll probably have to do it afterwards if you join without your CFA.
Yeah. I think, as you said, particularly in asset management, I think the CFA has become not a plus anymore. It's sort of a must at the moment.
Yeah, you don't have to do it before you start, though. I mean, the way that it has increasingly been that people try and do at least part of it before they start in the industry. It previously was always a bit like chartered accountants, or you had your education, you joined the industry, and then this was what you did at the beginning as your professional exams, and you did them whilst you were working. And I still think in many cases that's how it works. So I don't think you need to do it beforehand, but I do think it's something you ought to think about adding to your education if you're going to be a serious player in the field.
Yeah, absolutely. And if you want to have a family, you might think about doing it before you have kids. Yes, because it's not an easy exam. It has pass rates of around 45 to 50%. Yeah, that is true. I just have one last question for you, Jane. Is there anything that you would like to leave our audience with? And the second one is, where can people find more about what you're doing and what you've been up to?
The more research you can do and the more you can understand the area that you're going into ahead of applying, the higher your chance of actually doing well in getting through the interview process and getting the role. So don't think that you've got to just send out hundreds of CVs. Really focus on making sure that you do good applications to areas that you really want to get involved in. Focus is a core thing. As far as how you can find me, I am on LinkedIn. If anybody wants to get in touch, wants to link with me and look at things that I write, things that I send out, I'm very happy to link with any of your listeners. I will also be publishing a careers guide for the CFA UK in October, which is a online careers guide looking at future-proofing your career. So we have around 50 articles written by people in the industry about where they think the future of investment management is going. So that might be something to look out for. And that will be found on the CFA UK website, www.cfauk.org.
Okay.
And
perfect.
Finally, Accenture Analytics, if anybody wants to look at what's going on in that, behavioural finance papers which are put up on that website, that is www.accenture-analytics.com.
Okay, perfect. Well, Jane, again, thank you very much for being so kind and generous with your time. I think we've learned a lot today. There's a lot to digest. I think I could talk to you about not only careers but for portfolio behavioral finance for a long time. Again, thank you in the name of everybody who's listening, and I hope that we can stay in touch.
Pleasure. Thank you very much, and good luck with all that you're doing on Wall Street Lab.
Thank you.
Thank you for listening to the Wall Street Lab podcast. For the show notes and much more, visit us at www.thewallstreetlab.com. To see what we're up to before anyone else, subscribe to our newsletter on our website and follow us on Facebook and Twitter.
Disclaimer. Information contained in this podcast constitutes the opinions of individuals and should not be treated as investment, tax, financial, or legal advice. We take no responsibility for the accuracy of any statements made in this podcast. This podcast is for informational and educational purposes only, and it does not contain an offer to sell or buy any sort of financial products and should not be treated as advertisement for such. Any copying, distribution, or reproduction of this podcast without the prior permission of the creators of the podcast is strictly prohibited.